Good evening, everyone, and welcome to the Daily Volatility Box Report for September 10th, 2019. We are TOSindicators.com, home of the Volatility Box. For today's trading activity, we had three trades that set up in the S&P, the NASDAQ, and the Dow, which were winners. The NASDAQ was a slightly more aggressive trade if you took it. We'll cover it when we look at charts. We also had two trades that set up in the Russell, one of which was a winner, one was a loser, for an overall net negative P&L on the Russell of negative 275. Same situation on the bonds. We had two trades set up, one positive, one negative, for a negative P&L on the bonds of 343.75. And finally, we had one trade in crude oil. This was unfortunately one of those trades where as soon as we got our entry order filled, our stop order was also hit pretty soon thereafter. And so that was a loss on both contracts as well. However, our winners in the S&P, the NASDAQ, and the Dow helped us end the day up slightly positive, $881 and some change. And we'll also start by looking at the gold futures today to kind of talk away some of the takeaways, which will fuel into the NASDAQ futures. And for our Volatility Box subscribers, we're also going to be updating our trading plan thanks to a few suggestions. So be on the lookout for that, as well as a slightly improved indicator, let's say, in this upcoming week's updates. As a reminder, yesterday we released our next free indicator, which is the simple breakout tool, which helps you easily find breakouts. If you'd like to download this indicator for free, it's available on our website at tosindicators.com/indicators/simple breakout. We show you how we build it. We show you how to actually apply it in real life trading scenarios. And I think this is a pretty good tutorial. So give it a watch if you haven't already, or download the indicator and start playing with it right away. Let's start by taking a look at the gold futures. And we'll approach this market the way we approach all of our market before we talk about one of, the observations that a few of you have actually noticed and started emailing us about, which is what we'd like to talk about in today's video. So we'll start by drawing our line at that 6 a.m. mark where we check to see whether or not we breached either side's aggressive volatility box in that first hour. We see here that we very clearly did, and usually that's our sign to switch on over to the conservative volatility box. However, what's interesting, and a few of you have pointed this out to us, so we started paying a little bit more attention, and just for clarity's sake, we did not take this trade, and we did continue to use the conservative volatility box on gold. But let's take a look at what I think the few of you who have emailed us are trying to say. So what we get is while we breach the aggressive volatility box's cyan lines, we still end up getting a reaction in that first hour that is equal or opposite to the same distance between what we would have risked if this was a normal entry during any of the other hours, right? And so using that as another filter that essentially helps you figure out, are we essentially getting to the edge of the volatility box but still respecting it, or are we? Is that really a sign to switch on over to the conservative volatility box? And we might have respected it this time, but we don't usually respect it. And so this is something that we're just going to start to pay attention to. But if we kind of use that observation as, say, one more factor that we might start to include in our trading plan if it continues to be true over a series of trades, is we see here that this would have then given us permission to continue to use the aggressive volatility box, which then gave us our 6 to 7 a.m. trade entry. So if we draw our arrows between 6 and 7 a.m., then we see that here we actually did end up triggering a short entry where we had a really nice flush after where we hit both T1 and T2 and continued to drift down lower for the rest of the day in gold. So that's just one data point for us to start to pay some attention to. Those of you who have started to point this out, great observation. We're taking a look at it ourselves, and we'll use this to sort of talk about the NASDAQ as well, and what we did as we saw sort of this gold trade work out. So now let's head on over to the S&P futures, and we'll approach this the way we approach all of our markets. Once again, we'll draw our timeline, and we check to see whether or not we breached either side's aggressive volatility box in that first hour. We see here that in the S&P's case, we very clearly didn't, and so that was our permission to continue to use the aggressive volatility box. Here, we had our opportunity to go short as the S&P slammed into our volatility box's entry lines. Our stop was outside of the volatility box. We gave it 6 points of room. First target was the same 6 points, and our second target was 7.5 points at that target line, both of which were hit for a T1 and a T2. Our next trade that we'll talk about was in the Dow futures. So very similar trade setup here. if we draw our timeline, we see once again that we didn't get remotely close to breaching either side's aggressive volatility box. That was our permission to continue to use the aggressive volatility box for the rest of the day. Our entry came as we had an opportunity to get short as price slammed into our aggressive volatility box. Our stop was once again outside where we gave it 65 points of room. We ended up hitting that 65 points fairly quickly, but we didn't get the follow through to our second target, and so we hit just a T1, and our second contract was taken off at break even right here. Our next trade was in the NASDAQ futures. And so now, if we kind of bring back in that learning and observation, so we had just seen the gold trade end up working out, give us that nice flush. So we'll draw our same entry line at 7, and we check to see whether or not we breached either side's aggressive volatility box entry lines. Once again here, you see that we did at the very end and edge of the hour before we did have an equal and opposite reaction move in the opposite side of where our actual stop would have been had this been a normal hour entry. And so we use that as a permission to be cautious, but still looking at the aggressive volatility box to see if in the next hour we essentially just blew straight through. How did price look? And we see that we essentially started to really respect the aggressive volatility boxes. And as we had our entry to go short the S&P, the Dow, we also used that as an opportunity to get short the NASDAQ futures. Our stop was once again outside of the volatility box where we gave it 20 points of room, 20 and 25 points. And both of these contracts were hit for a T1 and a T2. Next, let's move on to the Russell futures. So Russell futures were a little bit trickier to trade today in that we had to change our volatility box midway through. We'll start by drawing our same entry lines. We check to see whether or not we breached either side's volatility box cyan entry lines. We see that we hadn't, and that was our permission to continue to use the aggressive volatility box. We then had an opportunity to go short as we slammed into the aggressive volatility box right here. Our stop was outside of the volatility box where we gave it 4.5 points of room, and we were looking for that same 4.5, which was unfortunately not hit, and our trade was stopped out. As we were stopped out, that was our sign to then switch on over to the conservative volatility box to see if that respected price action a little bit better. And so we'll just take the second. So if you remember yesterday's price activity along with another day last week, we had a similar trade scenario where we had our aggressive volatility box entries stop out, and then we had our conservative volatility box entries also stop out, only to see the moves go up in the same directions that we were shorting. So it was very easy here to be fearful and to say look away from the second volatility box entry, but we continued to stick to that plan here where we just followed the series of trades. We continued to use this trade as an opportunity to get short the Russell and follow the same rules that we've been following, which did lead us to our 2 stop outs in the last 2 trades. Our stop was outside of the volatility box where we gave it 3.5 points of room. We hit that first target of 3.5, and our second target was at that target line, which was unfortunately not hit, and so our second contract was stopped out at a break even, essentially in the close. Let's now take a look at the bond futures. We'll head on back to the aggressive volatility box and draw our first line. We check to see whether or not we breached either side's cyan entry lines. We very clearly hadn't, and that was our permission to continue to use the aggressive volatility box for the rest of the day. Our first entry came when we had an opportunity to get long the bonds right here, and we very quickly saw that it took out our stop of 8 ticks as the bonds continued to drift lower, which they continued to do for the rest of the day. As we were stopped out, this was once again our cue to switch on over to the conservative volatility box to see if that contained price action a little bit better. So once we switch on over to the conservative volatility box, we'll see that our next entry essentially came in the 8 to 9 a.m. hour where we had an opportunity to go long the bonds. Our stop was outside of the volatility box where we gave it 5 ticks of room, and we did end up hitting that 5 ticks right here. Our second target was at the target line, which was unfortunately not hit. So once again, we only hit a T1 and our second contract was taken out at break even. And finally, let's take a look at crude oil. We'll go back to our aggressive volatility box. But what you should see is that neither the aggressive nor the conservative volatility box really contained either of these trades. Using our timeline feature, we essentially had our permission to continue to use the aggressive volatility box as we hadn't breached either side's cyan entry lines. Our entry to go long was triggered right here. And this is one of those entries where we had an entry to go long, and in that very same candle, our stop 20 cents outside of our entry got taken out, and our stop was actually a little closer to here, and our stop was taken out. Usually, that's our sign to switch on over to the conservative volatility box, which is what we did. But as soon as we switch over, what you'll see is that even the conservative volatility box could not contain this price action, and we use that as our sign to just sit out the rest of the day in the crude market and really focus on where trades were working and we were respecting the aggressive volatility boxes. So to sum up, we had a total of 8 trades that took place today for a total win rate of 62.5%, and that's if you ended up taking that NASDAQ trade, which some of you may have, some of you may have not. I think a few of you even emailed us asking which volatility box we were on. So our 8 trades ended up leading us to an overall positive P&L day of $881.25. We were able to recoup all of the losses from yesterday and then be up just a very tiny amount. But that's a nice way to head on into Wednesday and see if we can now get into the more positive column in our P&L category for the week. Thanks for watching. Take care, and we'll see you in tomorrow night's Daily Volatility Box Report.